Good morning. Welcome to Market Monday for June 2nd, 2025. Well, that's a wrap. On May, that is, with the stock market finishing up over 4% for the month. Historically, when this happens, the S&P 500 stock market has never closed lower going out 1 year. There are 10 instances of that, some notable ones. 1990, coming out of the savings and loan recession. 2003, coming out of the third year of the dot-com bubble bursting. 9/11 terror attacks, etc. 2009, coming out of the global financial crisis. 2020, coming out of COVID. You get the picture. A lot of coming out of crashes. For fun, here's the 1997 drawdown and subsequent rebound compared with 2025. And here's the tech-heavy NASDAQ 100 coming out of COVID and the 2025 path there. March 2009, similar V-shape, and fourth quarter 2018. Now, in all these comparisons, the market did keep growing in the months ahead. Is it that easy? Or could it be like this? As it turns out, the magnitude and speed of the drawdown and subsequent recovery seem to be most reminiscent of 2001, as we're entering the dot-com crash. See here, drawdown, recovery, only to continue grinding lower over the years ahead. In 2022, ouch, drawdown, recover, drawdown, recover, rinse, and repeat. So which is it? 2001 or 2003? 2022 or 2020? It could even be this. The number of hot dogs consumed by the Nathan's Hot Dog Eating Competition champion, you see that? Almost tripling over the last 25 years. In the total number of automotive recalls, what do these two things have to do with one another? Absolutely nothing. This is one of countless examples of what we would call spurious correlations. Chad talked about this very topic, must have been years ago.
To that end, we've seen grown men and women draw lines on charts seeking to understand, drawing correlations in an attempt to figure out what the heck is going on. Here's the risk with that: spurious correlations. Here we have the divorce rate in Maine in red, trending down, that's great, versus the per capita consumption of margarine. Or how about the total revenue generated by arcades in red versus computer science doctorates awarded in the US? And one more for good measure, worldwide non-commercial space launches in red versus sociology doctorates awarded in the US. Spurious correlations indeed.
Indeed, just because two lines follow a similar path does not necessarily mean anything. This is another reason we believe we're entering the age of intuition, where we need to be critical, independent thinkers who use data to inform our decision-making rather than follow it blindly. For example, see this? We've all been hearing about this, the federal debt compared to GDP. And this is the companies in the S&P 500, their debt compared to their size. One went way up, one went way down. What has that done for the stock market since 2009? What about households? Liabilities as a percentage of assets peaked during the global financial crisis, now about half of what it was at the peak during 2008, and back down to levels not seen since the early 70s. Federal government debt way up, company and household debt way down. Correlated? And now the federal government is pumping out over $1 trillion into the real economy, investment and savings accounts every year. And you think we can still use the same old playbook for how we evaluate the economy and the markets? We don't. How about this? The amount of money in 401k plans quadrupled over the last 25 years, and more participants than ever buying every 2 weeks whether the market is up or down. Think this doesn't have any effect on the stock market? We do. And today we'll leave you with, speaking of 401ks, the federal agency overseeing 401ks, the Department of Labor, just last week rescinded 2022 guidance on cryptocurrencies like Bitcoin in 401ks, taking a neutral stance, neither endorsing nor disapproving of including them. Have a great week.